Hey everyone, and welcome to this explainer. Today, we're tackling the literal holy grail question that's on the minds of so many aspiring traders out there. How do you actually become consistently profitable? But listen closely, because we're throwing out all that get-rich-quick hype right now. There are absolutely no shortcuts here. Instead, we're going to unpack Professor Saladin Krit's highly realistic, step-by-step guide to professional trading. We'll be using ICT, that's Inner Circle Trader concepts, and order flow analysis. This is all about a highly structured, intensely disciplined approach to navigating the financial markets.
Here is our roadmap for today. We'll start with how to think like an institution, move into market structure and ICT concepts, tackle reading the order flow, lay out the professional trading process, and then finally wrap up with risk and trading psychology. All right, let's jump right into section 1. Think like an institution. We're starting at the macro level here because understanding how the market actually works under the hood is an absolute prerequisite.
You see, most beginners fall into this really common trap. They hyper-focus on finding the perfect lagging indicator, searching endlessly for some mathematical formula that'll magically tell them when to trade. But meanwhile, the real heavyweights, the banks, the hedge funds, the market makers, they're playing a completely different game. They aren't looking at basic retail indicators at all. They focus purely on market mechanics and hunting for liquidity. If you want to succeed, you've got to completely shift your mindset to align with those institutions.
To do that, to think like a bank, you've got to understand liquidity pools. Simply put, these are areas in the market where a massive cluster of buy or sell orders are just resting. Think of them like giant magnets pulling the market toward them. Institutions deal in such immense volume that they can't just, enter a trade wherever they want without causing terrible slippage. They actually need these deep pools of liquidity to fill their massive positions without completely crashing the system. So, the one crucial point to burn into your memory right now is this: price doesn't just move randomly. It moves exactly to where the orders are located. It's constantly seeking out the next pocket of liquidity to fuel the market engine. And honestly, once you accept that reality, those seemingly chaotic squiggles on a chart start to make a whole lot more sense. That brings us perfectly to section 2, market structure and ICT concepts. Let's zoom in and see how we map out these institutional footprints. Before you even think about looking for a trade entry, you have to learn to read the basic structure of the market. If the market is making higher highs and higher lows, well, it's kind of like walking up a staircase. Buyers are clearly in control. A break of structure, or BOS, just confirms that staircase is continuing. But more importantly, you have to watch for a market structure shift, or a change of character. These are those critical moments where momentum aggressively shifts and control flips right from buyers to sellers, or vice versa. Now, one of the most fascinating tools used to track this momentum is the fair value gap, or FVG. This shows us exactly where aggressive, unbalanced institutional buying or selling occurred. It's a spot where price moved so violently in one direction that it literally left a gap, creating a temporary market imbalance. It's almost like finding a really heavy footprint in wet cement. And the magic here is that price very often revisits these specific zones later on to rebalance the market, which gives us incredible trading opportunities. Similarly, we look for order blocks. These are specific zones where institutions are believed to have entered their significant positions right before a major price move. It's like pinpointing the exact neighborhood where a massive bank decided to set up shop and inject capital. When price eventually comes back to that neighborhood, we want to pay very close attention because those institutions are highly likely to defend their initial positions. And professionals filter out bad trades using a really simple concept: discount versus premium zones. It's the old buy low, sell high adage, but mapped directly onto your chart using Fibonacci levels. Think of it like buying a new TV, right? You want to grab it on a discount, not pay a premium when everyone else is rushing to buy. If you spot a bullish order block, but it's sitting way up high in a premium zone, a pro simply passes on the trade and waits for a better price. But you've got to beware of the trap: liquidity sweeps. Remember our golden rule about price moving to where the orders are? Well, institutions will intentionally push prices past obvious highs or lows because they know that's exactly where retail traders hide their stop losses. They create these sweeps to trigger those resting stops, grabbing the liquidity they desperately need to fuel their real aggressive move in the opposite direction. Let's move to section 3, reading the order flow. We're going to peel back the next layer of the onion and look right inside the actual price candles themselves. Order flow allows us to stop guessing and start observing. Instead of just seeing a static red or green candle, Order flow gives you literal X-ray vision into the bid and the ask. It shows you the raw, aggressive buying and selling pressure in real time. The ask shows buyers aggressively crossing the spread, while the bid shows sellers aggressively hitting the market. You're watching the actual battle unfold. Professionals use specific tools to read this data, things like volume delta, footprint charts, and volume profile. By analyzing these metrics, you can actually verify market behavior. For example, seeing absorption, which is where a massive resting limit order acts like a giant sponge, soaking up all the aggressive buying pressure without letting price move, that lets you confirm if institutions are actively defending those order blocks or FVGs we mapped out earlier. To get this granular data, pros rely on specialized platforms like ATAS, Sierra Chart, Quant Tower, NinjaTrader, or Bookmap. These provide incredible real-time visibility that basic retail software just can't match. But remember, a fancy tool doesn't automatically make you a master carpenter. Professor Crit reminds us that these platforms still require rigorous practice and serious screen time to interpret correctly. Moving right along into Section 4, the professional trading process. We've got our concepts, we know the data, so let's synthesize this into the exact top-down workflow a pro uses every single day. Here's how a complete system is built. First, you analyze the higher time frame trend. Then you locate those liquidity pools and wait patiently for a sweep. Once you see a market structure shift proving momentum is turned, you identify your specific order block or FVG. After that, you confirm the entry using order flow, and finally, you execute and meticulously journal that trade. Notice how this strict sequence forces you to wait for the market to definitively prove its intentions before you ever risk a single dollar. As Professor Crit so powerfully puts it, patience is a competitive advantage. Honestly, the ability to just sit on your hands and wait for that exact 6-step sequence to unfold, that is the defining characteristic separating the consistent pros from the people just gambling their money away. If the setup isn't there, you simply do not trade. Which leads us perfectly into our final section, risk and trading psychology. We are zooming all the way in to the single most critical failure point for beginners. This number right here, this is everything. Professionals rigorously protect their capital by risking only a tiny fraction, typically 0.5% to a maximum of 1% on any single trade. Risk management is infinitely more important than finding a perfect entry. If you risk 10% a trade, a tiny streak of bad luck will wipe your account out completely. But at 1%, you can comfortably survive those inevitable losing streaks. To survive, you must adhere to unbreakable rules. You need a 1-to-2 risk-to-reward ratio minimum, meaning if you risk $100, you are aiming to make at least $200. You need predefined stop losses that you actually respect, and absolutely no revenge trading after taking a hit. Enforce strict daily and weekly loss limits and practice all of this in a demo environment first. That preserves your capital so you can survive long enough to actually become profitable. The reality is pretty simple. Long-term success comes from following a tested process, not reacting emotionally to inevitable losing trades. Even the absolute best institutional traders in the world take losses. It's literally just a business expense to them. But they maintain absolute emotional discipline and consistency instead of letting a single red day ruin their mindset or their account balance. So, as we wrap up this explainer, I want you to ask yourself this tough question before you ever click buy or sell again. Are you ready to trade with professional discipline, or are you just gambling with a chart? Because the market does not care about your feelings, it only respects patience, process, and strict risk management. Thank you so much for joining me today. Keep studying those charts, stick to the process, and I'll see you next time.